The XY Advisor crowdfund is now live. To become an investor, head to virtual.com/company/XY Advisor. Make sure you read the offer documentation. It would be great to have you on as an investor. So feel free to join the cap sheet. Okay, on to the podcast. Welcome to the XY Advisor podcast. To join a global community of financial advisors sharing and learning with one another to drive the positive evolution of financial advice, head to xyadvisor.com. This episode is proudly sponsored by Integrity Life. Just like XY Advisor, Integrity isn't afraid to push for positive change in our industry, especially when it comes to the cost of life insurance. Right now, many Australians are underinsured, but Integrity is working to change all that with sustainable pricing and discounts that last as long as the policy. Next time you need a quote, why not give Integrity a try? Head to integritylife.com.au/XY. G'day, how's it going? What do you know? Strike a like. Clayton here from XY. I'm with Matt down in Melbourne. Mate, thanks for joining.
Absolute pleasure. Great to be back on the show.
Yeah. So the advice tech report has come out. I've had a little bit of a look through. There's a couple of things I kind of wanted to go through. First and foremost, this is like the third or fourth year that you've put this out, right?
Yeah, this is the fourth year that we've done it. And as my colleagues like to say, it's certainly the biggest and the best report we've done so far. In fact, it's so big that we've had to split it into two volumes. So there's now a advice tech report, which looks at, I guess, the trends that are happening around the industry, as well as a supplier's guide, which is equally, if not more interesting from my perspective.
Yeah, right. What was the thinking, I guess, if you go back a handful of years to why Netwealth wanted to start delivering these kind of reports? Like, what was in your mind or the team's mind that said, actually, we want to figure out what's happening in the broader sense for financial planning and technology?
Yeah, it's a good question. So as a business, one of our key values is curiosity. So we've always been really interested in what's happening both domestically, what's happening overseas, and more importantly, what can we learn and what can we then share back with the community? And at our core, we often get asked the question, are we a wealth management business or are we a tech company? And there's no really good answer for that, to be honest. I think any business this day, if it's not utilising tech, probably has got a relatively short life. So I think we're definitely both. But if you look at the tech side of things, we do play a fairly important part in an advisor's office as far as their tech stack goes. And really that sort of curiosity around how do we integrate and what's the ecosystem look like that we participate in? How can we help advisors understand it better? And how can we hopefully try and improve the industry through sort of the insights we're able to get and drive greater efficiency and increasingly now better client engagement?
Yeah. What clients expect has just exploded over the last, handful of years. I mean, the last decade especially, but I mean, it is what I expect from, a company when I purchase a service now is extremely high. I mean, recently becoming a dad, my wife gets me a 10 pass for CrossFit, right? Because, you got to watch out for that dad bod. And the CrossFit company doesn't give me a call, right? They just kind of give me this login and I get no real communication. It comes from a do not reply email. And I'm sitting here going, this is a really poor user experience. Now, that's just because I am now expecting to understand what's happening immediately, right? With all of my engagements, with all of my interactions, with everything that I deal with in life, I want the person who is providing me that service, whether it's a professional service or whether it's even a tech service, right? Whatever it is, I want to understand it without a user manual. And I want to feel like, especially if it's a service, I want to feel like someone knows about me as an individual, right? So I didn't know who to email. Eventually I figured out the online system, but I realized that my expectation of what I wanted and what was delivered was drastically apart.
And I think, Clayton, just on that, from a digital experience, unfortunately, that is probably better than many digital experiences than financial advisors are providing at the moment. The fact that you got an email and you got to log in, that's actually a long way ahead of where some practices are at, and that's a real concern. And to your point before, and it's probably one of my most overused quotes these days, is that our service expectations are set by the last best experience we had. So if your last best experience was with Facebook or Netflix or any of the big tech companies, which inevitably it will be these day and age, that's what you expect from all of your service providers. And that is an extremely high bar.
That's a really good point. Yeah. You're exactly right. That's probably why I was expecting so much and I was disappointed. And at the same time, I understand that these guys aren't a multi-billion, multinational dollar company. And yet I've just got that inherent expectation. And so with what advisors deliver, I mean, the expectations for what advisor has to deliver to all segments of the market has been increased, right? To compliance and regulation, to clients themselves. I think it's definitely difficult. And so to your original point, it was because the expectations are higher and rising quickly. How do we use technology to fill in those gaps? Because it's a must now. It's not a case of, maybe a decade ago, maybe a little less than a decade ago, people sitting around learning about how to put tech in their practice. It's way beyond that. It's going to be hard to deliver advice unless you're using technology. And so to your point to your report, I should say, what are the most obvious signs of an advisor benefiting from tech?
Yeah, it's a good question. And to your point, there is many different areas that you can enhance your business using tech. So it's not easy just to focus on just client engagement or the back office efficiency. It really has got to be pervasive in pretty much every part of your business. In fact, through the report, and we've tried to divide the different suppliers and providers into different segments, we've identified 26 different areas within an advice practice that can be enhanced using technology. Yeah. So with a choice of 26, you need to try and understand, what that means for you and your business, but also where do you start? And that's where it can become really confusing for a small business or even a big business. So typically what we're seeing out in the market at the moment, and this hasn't changed a lot for the last couple of years, is that most advice firms have typically got somewhere between 12 and 15 different tech solutions in their business or in their tech stack,
right, to
try and solve different problems. Now, the problem with that is a lot of these systems actually have overlapping features, which means that you're paying multiple times for fundamentally the same outcome. A lot of them don't integrate particularly well, and it's expensive. So when you start to add up all of these different costs, back of the envelope, we're sort of finding that the average cost per seat in a practice, so per staff member, is about $10,000.
Wow.
And we think that can actually be significantly reduced through the efficient implementation of tech and actually understanding what tech you want to put into your business and what the actual purpose of that tech is. So let's not go and buy the new shiny toy. Let's actually understand, is it about back office efficiency? Is it about delivering advice at a lower cost? Is it about delivering an exceptional client service experience? What is it that we're actually trying to do over the next 6 or 12 months, and it might change year on year, to try and reduce the number of tech providers to make sure that they're integrating properly and that they're actually delivering an outcome for the business.
Yeah, once a year at XY, we go through and we have an audit of all of our tech costs. And then we say, does Zoho do this? Right? Because I'm not sure if you're highly familiar with Zoho, but it took me a few years to come around to start using this product. But what they've done is they've achieved sort of this size and scale now where they just have teams dropping in new apps on a regular basis that you don't actually have to pay for. As long as you've got your sort of annual subscription, there's these new apps that are constantly dropping in. And so each year we're able to cut 1, 2, maybe 3 or 4 different tech, line items on our P&L and move it across into Zoho, which saves us a bunch of money, but also allows the different functions or the different parts of the business to talk to one another, because that's a huge part of it. Like if the average, did you say the average was around 10?
It's between 12 and 15. So, but believe it or not, the better advice tech firms are actually using more. It
Wow.
doesn't mean they're necessarily using them all well, but they're using more because they've got a better process around trialing and implementing those particular softwares. But I think doing that annual audit, incredibly powerful. And if I was to suggest one thing to the listeners today, do that. Go and have a look at actually what sits in your tech stack and have a clean up. I heard a great story recently about personal tech management, if you like, and this individual, I won't name my old man, he actually will deliberately cancel his credit card every couple of years because it cancels all the subscriptions. And then that gives you an opportunity to see which ones you use. And when you come across one that you haven't paid for, then you can subscribe to it again. But otherwise, you just accumulate subscriptions everywhere. And I thought that was actually not a bad tip.
Yeah, no, I fully agree. So with the things that are obvious, that's an interesting insight because there's so many, right? And each of those tech pieces, as you mentioned, won't necessarily speak to one another. They don't make the journey easy for either the advisor or the client, right? And so you've got a lot of competing communications happening internally. I think a huge part of tech is if it actually does create efficiencies, right? And it's kind of an interesting thing because you might like a particular feature. And so you might want to add additional, say, value to your client's life or to your internal process. So you say, actually, this will make whatever it is, it solves the problem. However, does it actually reduce the amount of time that you spend doing the whole process? And that's a key part. And I think it does actually take a little while to get your head around. But I think the first thing that you should pay attention to as an advisor is, as you mentioned, how many pieces of tech. So if I am using 10, okay, well, why am I using 10? Are they, do they talk to one another? And if I've got a piece of tech that only does one thing, can I move it across to another? Because realistically, even if you get Zapier involved, it's still pretty complicated. Like tech is there to design, like it's designed to make our lives easier. But unless we're in control of it, it doesn't make it easier. It makes it harder. And so sort of wrangling that into as few pieces of tech as possible, and making sure they all speak to each other just for the sole purpose that you've got a clear compliance line, right? So you can say captured here and all of that data has gone all the way through to SOA and it's kept over here. And I mean, that in itself is hugely valuable. Did you see any, because I believe your report mentions stars, but did you see any stars that were using less than the average and had sort of had, I guess, experts come in and really sort of cut it down, the amount of different programs they were using and making sure it was all running efficiently and effectively? What was that kind of like in a standard deviation, that top 2 or 3%? What did their practices look like?
Yeah, they're a really interesting group, actually, the Advice Tech Stars. So it's a new concept that we brought into the report this year to try and identify the best behaviours of this sort of unique and special group. So the Advice Tech Stars as a group, currently there's around 1 in 8 practices would be considered an Advice Tech Star if you had to look at across the whole industry. Typically, these Advice Tech Stars are clearly using Advice Tech well in their businesses. They're managing, in many cases, north of $500 million in assets under management. They typically have higher revenues. They've got better EBITDA margins, and due to the size of the businesses, they're also able to hire more staff. Now, that sort of seems at odds with getting efficiency from Advice Tech, but the reality is that it means that they're able to, in many cases, have a dedicated IT person. So they've got someone whose sole purpose is looking after the tech stack and the IT within their business, whether it's maybe even as an external consultant or someone that's got that sole responsibility internally. They also have a really clear roadmap. So as part of their business planning every year, they'll sit down and work out what they want to spend money on. And on average, they'll also spend more on tech than other firms because they've got that capability. So, they really are seeing the benefits of that Advice Tech. And what we also saw that if you look across the sort of the areas that they're investing in and putting that technology in, the first is absolutely around delivering exceptional client experiences. And we'll come back to that, I think, because that's probably one of the key areas. The second, and this is very much COVID related, is they're investing into how do they support a distributed workforce and also a distributed client base. And we've seen, I think, some incredibly positive signs come out of COVID, not ignoring the sort of personal toll and the health pandemic that sits behind it. What we've really seen is that tech adoption by both advisors and also clients has probably accelerated by between 5 and 10 years. And that's huge. So we look at, people now using, virtual meetings. That's just how we communicate. We wake up in the morning and from 8:30 till 6, I'm now on Zoom or Teams. We're using far more multi-mode communication, so people are communicating via WhatsApp and messaging, and becoming far more social in that regard. Something as simple as digital signatures. It's taken a long time. Everyone knew that they should probably move in that direction, but they haven't. Whereas now, most people don't have a printer at home to do work, let alone to sign client documents. So that is now pervasive in sort of pretty much all of our interactions. And as I've often said there, a big part of digital signatures was actually sitting with the manufacturers, so sitting with us. And certainly us and others I know have sort of accelerated that project. So we now accept digital signatures on pretty much every document, except for, I think, binding death noms and powers of attorney. Without it, we just simply couldn't be doing business. And so it's become just, again, embedded in how we do business. And I think those habits, which typically take about 3 months to form, are now with us forever. And that's a real positive, because it's going to drive efficiency, but also by virtue of that, actually improve the client experience. So really positive in that regard. But also just the whole work from home trend, which I'm, to be honest, I'm loving. And again, having been doing it now for close to 6 or 7 months, I think going back to the office is going to be hard, and it's going to be a hard habit to change. So that one's a bit of a given. And the other one that's quite interesting is just capitalising on new revenue streams. So looking at how do they move into adjacent services or offer new services, to those existing clients. So robo is the obvious example, and we can chat about that because I don't necessarily yet think it has a place in Australia, but it might be mortgages or accounting or bookkeeping. So the whole range of different areas that advisors are looking at that they can enable using technology. So each of those 3 areas, really big focus for the industry, and for Advice Tech Stars, they're really taking advantage of it.
So you mentioned the robo. I think that's a really interesting thing to touch on. See, the conversations that I have with advisors is they're saying, okay, how do we deliver as much value to their clients as possible? So it's almost as if, and XY has largely grown in conjunction with this pursuit. It is, what can I do to add value? Right? Because the more value I add to a client's life, the more revenue I can earn as myself and get more clients, right? So there's a bunch of really important reasons to do your job as well as humanly possible. And it often comes down to, how do I improve this part of my service, or how do I improve that part of my service? On the flip side of that, I see a lot of the market talking about scaled advice or robo advice, right?
Episodic advice, I think is the new term.
Yes, episodic advice, right? And so to me, and the conversations that I'm having, that would be the complete antithesis of what advisors are aiming to do. They're aiming to become more valuable and play a bigger role in their clients' lives, not to do this transactional episodic advice. So I'm interested to see where you think the future's headed, because we've got robo advice, and you mentioned you don't quite think it has its place in Australia yet. I've been thinking that for a while, but I'm also interested to see, when do you think it would be valuable? And more importantly, how an advisor can add that to their repertoire to add more value to more people.
Yeah, and I think defining robo is important. In Australia, robo really means automated investment service. And to be honest, there's a whole range of ways you can do that. So with robo particularly, a number of practices are looking at it, and there'll be different ways that people are thinking about it. But a lot of practices are saying, is it a way to service my C&D clients or my smaller balance clients? So to your point earlier, how do I service more clients? I don't understand why that is important, because if you're looking at putting in place a robo advisor, and we'll come back to automated investment services in a moment, you're delivering a service which you may or may not be making a margin on, or it might be a subscription basis, to nurture a client base which is actually creating risk for your business that may or may not convert into a full service client in the future. So it seems like a very high cost, risky strategy to nurture a lead generation strategy. And I can't quite correlate those two. So increasingly, and I think this is unfortunately, where we are in the industry at the moment, the cost of advice has gone up. We all know that. So people are moving increasingly to those sort of clients that can afford to pay $3,000, $4,000, $5,000 a year, which means that there is a significant segment of the Australian market that can't. Now, perhaps that market is better off with a industry fund. Perhaps they are better off with a robo-style advisor. But that's a specific business model. It's not a way to generate leads for future clients, in my mind anyway. I think really when people are thinking about robo, and this is where we're doing a lot of work and thinking at the moment as a business, it's actually creating an engagement model. So how do I create a high-touch engagement model in a digital environment? Now, what is it that people are actually valuing from an engagement model? Is it investments? Because if it's investments, you can put them into a managed account. You don't need a robo solution to do that. And certainly that is a big trend at the moment. We're seeing, particularly post-pandemic or post the last 3 to 6 months, those that had managed accounts in their business versus those that didn't got through pretty well unscathed. They're able to regularly meet with their investment managers, or if they had a private label, with their investment committee, take overnight data and then implement changes into portfolios rapidly. So we looked at we looked at the history through the last 3 to 6 months. And people were regularly trading. They were able to sell out of assets they shouldn't have been in on the way down. And on the 19th of March, and this figure is staggering. So through our managed account offering, which is about 5,000 clients and about $5 or $6 billion, on the 19th of March, which was pretty much the low point of the market, we processed 42,500 transactions. And 70% of those were buys. People have made a lot of money on the way up from that. And that was just the ability to suddenly implement a consistent experience across all clients in a highly, highly automated way. So getting back to my point, if that's what you're trying to achieve out of a robo, you don't need a robo. All those services already exist. So therefore, how do we actually provide or start to build out a really engaging service that, going right back to the start of the conversation, that competes with the likes of Facebooks and Netflix? Yeah. Isn't it more about communication? Isn't it about being able to provide utility, whether that's through things like cash flow or budgeting or regular investment updates? There's a whole range of things that you can engage with digitally with a very broad number of clients that can then hopefully make sure that when they need help, they either press a big button that says speak to my advisor, or more importantly, you can use the data, and your data is then telling you when to contact that client. So, they've just had a significant birthday milestone, or their contributions are under or over, whatever it might be, or they're logging on more frequently because they're anxious. Data can actually be that trigger that helps you to then go and speak to the client at the right time. And I think all those sort of scenarios are far more interesting than providing a automated investment service, which really isn't what the clients are always looking for. They're actually looking for someone to help coach them and guide them through their financial issues.
Yeah, that's a really good point. So you see robo advice as a tool in as much as it helps advisors, as being almost like a key milestone personal assistant for the advisor. So
for robo to be successful, it needs to move into more strategic advice. And yes. I think that's many years off, as opposed to just an investment solution, because as we all know, investment's clearly important, but it's actually the strategy that goes around it and the ability to hold a client accountable for that advice that's really important.
That is really interesting. Is any tool out there doing that?
Not that I can see. Certainly, and this leads into one of the things we're going to talk about today. Client portals is clearly, a step forward. Now, it's not doing robo, but it is providing a range of different engagement solutions. At Netwealth, unashamedly, that's what we're doing a lot of work on at the moment, and we'll have something out towards the end of the year. But bringing people back into your environment and having a whole lot of touch points outside of just investments, we think is where the market's going. So helping them with tasks and documents and in-app chat, all those sort of things, so that it becomes a real sort of a live experience, as opposed to someone logging in to look at their portfolio balance maybe once a year when they get their annual statement. So yes. The idea of being able to provide your client with a digital logged in environment is very much almost like a holy grail, right? Because it's difficult. It's difficult because the expectation is so high, right? I mean, XY, we took on, it's an ambitious goal of creating, you could call it Facebook for financial planners, right? And so, and you've done well.
Yeah, thank you. And in order to compete with Facebook, like there needs to be a higher level of user experience.
Correct.
And we spent about 12 months building our own one, and we launched it to some beta testers, and everyone said, we love what you're trying to do, but this is horrible. I'm never going to use it. So we went, okay, interesting. So we ended up going with a third party over in Silicon Valley called Mighty Networks. But that was only to prove that advisors wanted a place to talk. However, you still need to provide that outrageous user experience, which we just didn't have the money to be able to do. And thankfully, we're able to sort of rent that place for a couple of years.
And that's been our biggest challenge as we've gone through this project. We've done huge amounts of user testing, and what we thought was the killer app at the start, it turned out was very misguided. We had to completely overhaul all the navigation and pretty much everything about it. But that we found out early on in the piece, which is a much better time to find out about it. But from the user experience perspective, particularly when you're spanning so many different segments, and even in the XY community, you've got a number of different segments. How do you design something that's going to be attractive for an accumulator, but also something that's really useful and appealing to a high net worth person that might have $5, 10 or $1 million or more? So trying to match Silicon Valley with private client, we think we've got pretty close, but it's been a good challenge. Actually,
that is a very intense challenge, because those two markets don't have too much in common. They've
got different account balances, but you'd be surprised at the commonality. They're looking for a great user experience.
Oh, sure. Yes.
They're looking for something visual. They want something that they can navigate around easy. So there's a lot of commonality, even if the outcomes and the numbers are very different.
Yes. One's drawing down and one's building up. Okay, interesting. What would you see as, and this is kind of going back to the start of the conversation, what is the uncommon thing that you didn't expect to find in advisors that are doing well with tech? Is there something that's sort of not immediately noticeable, but there's a weird sort of trend, you're not quite sure why? Is there something like that?
When you actually delve down into the data and you start to look at the type of groups, the answer is actually really obvious, which is that those practices that are considered advice tech stars have got a Silicon Valley mindset.
Right.
So they're open to change. They're the first ones to try out the shiny new toy, even if it's not necessarily going to be implemented in their business. They're not waiting for something to be very mature and effectively tried and tested before they put it into their business. So they're looking to make change. They're open to change, and therefore they're going to be more successful by virtue of that in the advice tech space.
So it's essentially an early adopter that's a common threat. So the early adopters are ultimately doing better with tech.
Early adopters, but that doesn't mean that they're putting in every bit of new tech. It's more about they're open to new ideas. So they're open to the possibilities of what they can achieve with tech, as opposed to seeing it as a cost within the business, if you like.
Yeah, that makes sense. I'm interested to hear what you personally think about the future of financial advice in this country. We've gone through a hell of a lot of change recently, right? An accelerating amount of change. And I think change in real time is really difficult for people to keep up with, but it is the expectation that has been put on financial planners over, pretty consistently. What do you sort of see? I think I saw a report come out today. It was, licensee fees are now on average about $40,000, give or take.
I'm surprised it's that low, actually.
Yeah, because I'd seen something earlier done by the FPA that put it closer to 60, right? So what do you see as, the trends over the next sort of 5 years?
Who knows in 5 years, over the next couple of years. There's a whole range of things. The industry is still incredibly fragmented, and that's an environment that we actually really enjoy playing in, because people are, again, open to change. They're looking to make change. Across the industry, we're seeing a blank canvas approach to the future. So people are actually taking the opportunity, whether it's a new licensee or having to change their business model around regulations, to actually say, okay, well, where do I want to be in 2 to 5 years? And what does my business look like? How am I going to get there, and who do I want to partner with? Because I think even the landscape as far as sort of who's available to work with has changed dramatically over the last couple of years. So that's a real positive. From a licensee perspective, we're seeing what I'm calling sort of people moving on to their second and third marriages. So there was the initial sort of movement from a lot of the big institutional groups. Grass was greener. They made a jump, and it may have been to a small group of maybe advisors that they were friendly with, or it may have been to another larger independent. For whatever reason, it hasn't worked out. And they're now looking at sort of what the second and third steps look like. So there's still a lot of movement, and it's not like everyone's just going to say we've got 18,000 advisors, they've all moved licensees, that's where it stops. It's far from ending, and we're still seeing a huge amount of movement. I think there's a big growth at the moment in self-licensing, and I think that's being driven again potentially by some of the disappointment that people have felt with some of these sort of larger groups. But likewise, we're also seeing some really good quality, larger national groups emerging, becoming even stronger, and having the financial resources to actually, spend time on educating their advisors about the technology available, as well as all of the sort of educational standards and ethical requirements that they need. So I think licensee land is still going to change a lot over the next couple of years. From an advice perspective, we've talked about it, that, COVID has been incredible. A lot of advisors have been wanting to make changes for the last 2 to 3 years. And since we've started the report, every time we look at the same metrics about intention to use, I intend to use this over the next 12 to 24 months. It's all the big ticket items. And yet those numbers have not changed at all up until now. So people have had best intentions, but just not acted on them. Whereas now we're going to see some really significant change, I think, across all of those key metrics. I think data is going to play an increasingly big part in advice through client portals and being able to sort of drive what we call actionable insights. But also it's the first time really, in probably ever, that there's solutions out there that can bring all of the clients' data together and start to actually give them that whole of wealth view. And that's really, really exciting from our perspective. And I think we will start to see a lot more episodic advice. So it means engagement models are changing, but that advisors will need to be able to provide one-off advice. So I need help on my mortgage, I need help on insurance, whatever it might be. And not every client actually wants an ongoing relationship, but they want to know that there's someone there to talk to if they need help. So I think we're certainly going to see a number of new tools coming out in that space.
On the licensee front, the FPA came out and said that they're not quite sure if the licensees are going to exist. Do you have a view on that?
Oh, look, I was surprised actually that the FPA did come out with that view. It sort of came out of nowhere. Normally these things sort of get discussed and talked about and you get to a point, whereas I think that comment or that position probably blindsided a lot of people in the industry. I don't necessarily have a view on it. I think that the model that they're talking about is the one that exists overseas.
Yeah.
It's quite specific. And again, there's various sort of forms of how it looks overseas. So the UK independent groups aren't necessarily independent. It just means that they can use a broader list of providers, but not the whole market. So it's actually very complex to compare. But I think licensees play a critical role. And I think importantly, it's going to be around helping advisors across things like practice management. It's going to be things, making sure that they maintain their compliance standards. But I think like many other things we're seeing in the industry, it needs to move more and more towards a user pays model. So there's no point having advisors pay for things and pay, $60,000, $70,000, $80,000 for services that they may not actually need or want. So how does that model change? I don't think we're going to end up in a subscription model, but yes, certainly being able to have a bit of granularity around what they want and how they access it.
Yeah, and I think as clients have expected more, I think even advisors now expect more as well. So if advisors are paying for, let's call it practice management help, right? Mm-hmm. Well, what are they actually receiving? And previously it probably wasn't that discussed, it wasn't that critiqued, but now you've got individuals like Sue Viskovich and Stu Bell and like a whole number of these types of people who can really help with practice management. And so is the licensee providing that level of value, or should the individual advisor be spending that money on individually going out and sourcing that kind of value for themselves? That's a question that is very difficult to ask and answer. But it's the kind of thing advisors are looking for value. And it's kind of interesting looking just at advice as a whole, sort of, you could use the word blossoming from its own little insular view of this is how we do things. And it's very different to everything else. And now a lot of these regulation changes has forced it to enter into this open market of, oh, wow, this is actually how all professions operate, and, EBITDA and things like that, which wasn't really necessarily spoken about even just a handful of years ago. It's now operating in I guess, like a level playing field with the rest of the professional services that are out there. And the expectations from everyone's gone up, and a part of me, I have a little bit of empathy because change is difficult, but at the same time, so many advisors love where the advice profession is headed that there's I guess there's a lot of that sort of, well, it's a burden, but we're willing to carry it to get us there. Mate, just to leave us, on a high note, what's the plans for, Netwealth? You mentioned very briefly at the, what's coming up in the end of the year. What can you sort of give us?
There's always heaps going on at Netwealth, but there's a couple of big things we're working on at the moment. User pay is probably a good segue. So increasingly, which may or may not be popular with many practices, don't know, we are looking at having to change the way we think that platforms need to be priced. So we're seeing prices have clearly come down across the industry, and we're always happy to be competitive. But we need to price, if we're pricing the commodity, you need to pay for that. But there's a whole lot of other things that we're doing that are over and above what other platforms are doing. So how do we actually make sure that we get, like an advisor would, remunerated for the additional services? So we've recently launched in beta mode, and we'll be rolling it out more broadly, a service called XWrap, which is a non-custodial off-platform administration service. So it's a bit of a mouthful, but effectively it allows a practice and advice firm to manage your clients' assets that sit off platform that can't live on a custody platform for whatever reason.
Right.
And then that flows through into the broader reporting. So you can get performance reports and transaction listings and asset allocation. And that seems to be really resonating, and it sort of helps fill in a bit of a gap that existed in the market. Our client portal project is getting very close to being beta launched, hopefully in early November, and that'll be a whole of wealth offering that allows, again, clients to see their platform assets, their off-platform assets, bank feeds, property, a whole range of data that's generally not broadly available, as well as making sure that the platform remains ahead of the game and number one in the industry. So never a dull moment.
Very cool. Well, mate, thank you so much for sharing. Really appreciate you coming on and giving us these insights. Congratulations on the 4th year of the report. And
thanks for having me.
Mate, no worries. Speak soon.